The smarter you are, the more money you will lose. I know how that sounds. I know what you are thinking. You are thinking that cannot possibly be true, that knowledge is an edge, that analysis is protection, that the more you understand, the safer you are. But I have watched brilliant men, a discounted cash flow in their sleep. I have watched those men walk confidently into positions and lose everything. Not because they were careless, because they were certain. And certainty in the market is not a gift, it is a trap. So before you tell me how much you know about this market, I need you to ask yourself one question. When was the last time you seriously considered that you might be completely wrong? It was September 1992. I was sitting with my team, and the position we had built against the British pound was larger than most people could comprehend. We had committed billions. The thesis was clear. Britain had entered the European exchange rate mechanism at the wrong rate. Their economy could not sustain it, and the government's attempt to defend it with interest rate hikes was already failing. The logic was airtight. But here is what most people never tell you about that trade. There was a moment, a quiet, uncomfortable moment, when I looked at everything we had built and I genuinely asked myself, what if I am wrong? Not as a formality, not as a hedge, as a real question. Because the British government was fighting back. Norman Lamont stood in front of cameras and told the world they would do whatever it took. Interest rates were raised to 10%, then to 12%, then to 15%, all in a single day. The pressure was enormous. Any trader who had built their conviction on certainty alone would have felt that pressure as a signal to retreat. But I did not retreat, not because I was certain I was right. I stayed because I had built the position on something deeper than certainty. I had built it on a model, reflexivity, that told me the very act of the government defending the pound was accelerating its collapse. Their defense was the trap. Their confidence was the fuel. We made over $1 billion in a single day. But the lesson I carried from that trade was not about the money. It was what I saw in the faces of the analysts on the other side, the economists, the treasury officials, the seasoned professionals who had studied currency markets their entire careers. They were wrong not because they lacked intelligence. They were wrong because their intelligence had convinced them the situation was stable. And that is where it always begins. The first thing intelligence does in a market environment is construct a narrative. A smart person reads the data, synthesizes the information, builds a coherent explanation for what is happening, and then, almost without realizing it, begins to defend that explanation rather than question it. This is not a flaw of weak minds, it is a flaw of strong ones. The stronger your analytical framework, the more evidence you will unconsciously filter through it. You will see confirming signals more clearly. You will rationalize contradicting signals more easily. You will hold your position longer than the evidence justifies, not out of stubbornness, but out of the very intelligence that constructed the thesis in the first place. I have spoken about this through the concept of reflexivity for decades. Markets are not independent of the participants inside them. The beliefs of participants change the fundamentals, and the changing fundamentals change the beliefs. It's a loop, not a line. And a mind that is too certain breaks the loop. It stops receiving the feedback. Think about the hedge fund managers who built elaborate quantitative models before 2008, some of the most sophisticated mathematical minds on the planet, constructing systems of extraordinary complexity. And those systems failed, not because the math was wrong, the math was perfect. They failed because the models assumed that the behavior of the market was independent of the people trading it. It was not independent. It never is. The most dangerous investor in any market is the one who has just finished explaining exactly why they cannot lose. A truly intelligent approach to markets requires what I would call fallibilism, the active, disciplined belief that your current view is probably wrong in some way you haven't yet identified, not as a disclaimer, as a working assumption. Remember that. This is a distinction that sounds subtle but changes everything. Most intelligent people enter the market with a binary framework: right or wrong, correct or incorrect, win or lose. They spend enormous energy constructing arguments for why they are right, and then they wait for the market to confirm it. But the market is not a judge. It does not rule on the quality of your thesis. It only reflects the aggregate behavior of every participant trading at any given moment, many of whom are operating on emotion, on rumor, on entirely different time horizons than yours. Being correct in your analysis can still result in significant losses if the timing, the sizing, or the consensus is misaligned. I learned this directly in the Asian financial crisis of 1997. I saw the structural vulnerabilities in the Thai baht. The analysis was sound, but I also understood that the timing of a currency break is not determined purely by fundamentals. It is determined by the moment when enough participants in the market shift their behavior simultaneously. You can be right about the direction and still be devastated by the timing. The intelligent investor who has never internalized this principle will keep doubling down on a correct thesis as it moves against them, convinced that the market is simply taking time to catch up to the truth. And sometimes they are right, and sometimes they run out of capital before the market agrees with them. Keynes said it better than anyone: markets can remain irrational longer than you can remain solvent. Being right is irrelevant. Being right at the right size, at the right time, with the right exit, that is all that survives. This requires a complete restructuring of what intelligence means in a market context. It is not the quality of your analysis, it is the quality of your decision-making under conditions of radical uncertainty. Sit with that for a moment. There is a reason the most educated participants in a market are often the most exposed during a crash. It is not simply that their models fail, it is that their confidence in their models prevents them from seeing the failure in real time. The human brain is an extraordinary pattern recognition engine, and intelligence amplifies that engine. You train for years to recognize patterns, to understand structures, to build predictive frameworks, and the brain becomes extraordinarily efficient at applying those frameworks automatically, without conscious effort, without question. In most domains of human achievement, this is exactly what you want. Mastery in medicine or engineering or law means that the expert can quickly recognize a known pattern and apply a known solution. But markets are not static systems with known solutions. They are adaptive, reflexive environments where the patterns themselves shift precisely because enough people have recognized them. When a strategy becomes widely known, it stops working. When a valuation metric becomes universally trusted, it becomes the vehicle for the next bubble. When enough intelligent people agree that something is safe, that agreement itself creates the conditions for catastrophic risk. I have seen this cycle repeat with remarkable consistency. Long-term capital management in 1998, Nobel laureate, the finest quantitative minds in the world, a firm built entirely on mathematical certainty, collapsed so spectacularly that the Federal Reserve had to coordinate a private bailout to prevent systemic contagion. Not because they were unintelligent, because their intelligence had removed all doubt from the equation. And markets eventually punish the removal of doubt. My entire philosophy is built on one foundational belief, that I operate under radical uncertainty and that my understanding of reality is inherently imperfect. I do not trade to be right, I trade to survive long enough to be less wrong than the consensus. The moment you stop questioning your thesis is the moment the market begins writing your obituary. Remember that.
I want to tell you something I do not say often. I have been wrong. Not once, not occasionally, repeatedly, significantly, in ways that cost real money and required real honesty to acknowledge. In 1987, I anticipated the Japanese market would crash before the American market did. I was wrong about the sequence. The American market fell first, and the positions I had structured around my conviction turned against me badly. I lost hundreds of millions of dollars in the crash. I did not predict it incorrectly because I lacked information. I had more information than almost anyone. I predicted it incorrectly because my model told me a story, and I trusted the story too much.